first principles, there's too much debt and we can't manage it and we don't have the money to pay for the interest, let alone actually pay off any of the debt. And that's the dirty truth. And we don't raise enough taxes because economic growth is trending lower over time due to demographics. So you don't have the money to pay the interest. You can't pay off the debt. So you're in this trap where you have to, everything is about managing the debt.
Right.
And from 2008 onwards, the number of these ridiculous parts of the plumbing system that got invented to stop that bit broke and then that bit broke and that bit broke, it's because the whole bloody thing is broken and we're just trying to tape it up. Which is why, in the end, I saw this coming back from 2008, 2012, is why I got into crypto. I got into crypto for this.
Government bonds may not get as much attention as stocks, but they are a critical part of the financial system. Last year, U.S. Treasuries like stocks and other investments were hard hit as the Federal Reserve jacked up interest rates to fight high inflation. The Bloomberg Barclays U.S. Aggregate Bond Index, a benchmark that is kind of like the S&P 500 for bonds, fell by roughly 15%, its steepest drop since 1976 when it was created. This year, stocks have staged an impressive recovery. The Nasdaq is up more than 30% so far, but the bond market has barely rebounded. That's largely because investors are betting inflation will remain above the Fed's target for a while, which means policymakers will have to keep interest rates high. Weaker bond markets have all kinds of implications for the economy and for consumers and businesses. When bond prices decline, their yields rise, and yields influence all kinds of interest rates. Credit card rates are going to stay elevated too, says Stephen Juneau, a senior U.S. economist at Bank of America. Mortgage rates are going to stay elevated. Auto loan rates are going to stay elevated. And all of that starts to eat into your consumption spending ability because so much of your money is going to servicing those debt payments. In other words, borrowers end up paying more in interest. That could lead to a broader slowdown in the economy and potentially to more delinquencies and defaults. We are now going to join macro guru and expert Raoul Pal as he discusses the bond yields, inflation markers, rate cuts, and his outlook on the global economy. As you watch, don't forget to show your support by hitting the like button, subscribe, and drop your comments below.
And I've spent a long time actually thinking about this. I say that flippantly, but actually I spent a long time thinking about this because all of the business cycle indicators, all of the inflation, forward-looking inflation indicators, all of the unemployment indicators are all suggesting the bond yield should come down and that inflation continues to fall, both at core level and at headline level, and that unemployment continues to slowly grind higher. So why are bonds not suggesting that? You know, while equity markets already started pricing in the fact that there's more liquidity in the system. And I think it's down to supply. I think it's really down to supply because the Treasury has to issue a lot of bonds to finance both the interest payments from the bonds that are coming from maturity, set at higher rates, and the new borrowings that they have. The bond market is already trying to absorb a bunch of this stuff, and there's just not the ability to absorb it all. So supply is pushing yields higher for the time being as the Treasury rebuilds its coffers. The issue is there's about $6 trillion of debt maturing between now and the end of the year. What the Treasury have been doing is issuing short-dated notes generally to finance it. The reason they're doing that is they don't want to lock in 5% rates because before you know it, the budget deficit explodes high.
Right.
So there's a game that I think they're playing here is the Federal Reserve have to, and all the central banks doing the same game, because I think they're all in cohorts, part of this everything code theory. They are going to try and hold this rates up as long as possible to make sure inflation undershoots. Because when it undershoots, they have the cover to cut rates back down to trend rate of GDP growth, which is like 1.75%. This issue of the Fed staying as long as possible because they really want to have the complete green light to do what they want, crush inflation expectations. The market knows rates are too high, obviously. So they're saying, listen, you can't do this for long.
Right.
And the Fed keeps shunting them along. And this is the higher for longer argument, which has been pretty accurate. The question is how fast does it reverse? And the market never usually forecasts this right. Normally, once they do cut, they cut faster than the SOFR curve or the Eurodollar curve used to in the past. So, you know, we have to wait and see. But it's all to play for in Q4 for me.
This quarter, the U.S. Treasury Department says it plans to borrow more than $1 trillion, over $250 billion more than it forecasted a few months ago. Given the state of bond markets, the government needs to pay higher interest rates to investors. That means things can get very expensive very quickly, widening the country's budget deficit. Fitch Ratings singled out the cost of higher interest as a factor when it downgraded the U.S. long-term credit rating last week.
If rates become unanchored from inflation, economic growth, or anything else, it says there's a structural problem in the market. We know there's massive structural problems in the lending markets because there's too much debt. And if you lose control, the Federal Reserve can't allow loss of control. And don't forget, they're just being downgraded because of the shitty mess that the US is in because of its political impasses and everything else. Is if they lose control of the bond market, that's the world's anchoring asset. This should not be allowed to happen. So in which case, they will come in and stop it. And we saw that in March of 2020. They did the same where rates got ridiculous on the other side, going down, just completely, all liquidity dried up and the market broke. We have a risk that we could break the market again here. And in which case they will step in and say, we'll have to increase quantitative easing and buy bonds. But you could do it at a fixed price and say, we'll buy all bonds at 4.25% or whatever the number is, that they say, look, enough's enough. We know that the regional banks have problems with their bond positions. And if bond yields keep rising, they keep losing money. That makes them illiquid. And with high rates, there's money moving from deposit accounts in banks that are only paying 0.5% and moving to money market funds that are paying 5%. So they're losing their deposits and they've got losses here. Every time you take a deposit out, you have to kind of unwind some of the trades, but they're all down. So there's a huge, massive mark-to-market loss that goes on. And they're having to borrow money from the Fed to fund that right now. So in this financing facility that the Fed set up. Also, if the bond market breaks, it means that there is not enough participation from the key participants, banks, asset managers, market makers, to keep market liquidity. So prices start gapping around, setting interest rates which were not the intention of the Federal Reserve. And if they're setting interest rates that were not the intention of the Federal Reserve in a very meaningful way, then it can create problems. So it is very risky here, what happens to the bond market. So people need to keep an eye on it. The equity market might not like it either. Even the crypto markets may not like it if yields go up, because that puts pressure on everybody on their borrowing costs. Now, most mortgages in the United States are longer duration, but we've seen credit card financing rise. We've seen car leases rise. We've seen all forms of short-term financing rising. Corporations rolling over debt if they've got short-term debt, that's going up. And the US government themselves need to fund their bloody debt, right? And they're rolling over all of this debt. And the last thing they want to do is try and roll out 10-year debt at 4.5%, when the last time they were paying the interest on it, it was 1.5%. Suddenly you triple your interest payments, and then you have to borrow more money to have the interest payments because the taxation rate's low. We've got some dangerous dynamics here, which is why they need to cut rates. You could see that the end game of the debt, and in fact, I've done some videos called the end game, make it impossible to deal with. Now, most people think there's a debt default. I don't think there is a debt default. I just think that the use of central bank balance sheet goes exponential, which increases the cost of assets, but nobody's wages go up. It's like a mutualization of these interest payments across the general population without raising taxes. It's the same thing. But
and by the way, the decline in purchasing power. And by the way, the decline in purchasing power in the currency.
Yeah. And that's a mutualization of losses amongst everybody. But rich people hold assets, so they're protected. The less well off have incomes. Their incomes don't go up as much as the assets, so they're poorer. So that's where we're getting this income disparity.
U.S. Treasury yields will fall in coming months despite clear signs the Federal Reserve is reluctant to consider rate cuts anytime soon, according to bond strategists polled by Reuters, who said the 10-year yield would not revisit its cycle peak. Although yields have mostly defied predictions in recent months and come in higher on a still resilient economy and an inflation-focused Fed, bond strategists, mostly at sell-side firms, have clung to their expectations for declines. The median forecast for the 10-year Treasury note yield was 3.6% in 6 months, a slight upgrade from 3.5% in a July survey, and compared with 4.03% on Wednesday and a cycle high of 4.34% last October, the August 3-9 poll of 41 strategists showed. But some analysts are showing signs of hesitation about steep falls. The 10-year note yield is still well below the 2-year equivalent, usually a sign of impending recession at a time when most of the talk in markets is about the Fed avoiding one. We now see more limited scope for yields to fall over coming quarters, said Phoebe White, U.S. rates strategist at J.P. Morgan. They upgraded their year-end 10-year yield forecast to 3.85% from 3.5%. A stronger growth trajectory into next year than we previously forecast should allow the Fed to stay on hold for longer, and we now expect just 25 basis points of easing per quarter beginning in Q3 2024, she said. But an overwhelming 81% majority of respondents to an additional question, 29 of 36, said the 10-year yield would not revisit its October 2022 high of 4.34% at any point in this cycle. The remaining 7 said it would, with most expecting that to happen this year. A hotter-than-expected July U.S. Consumer Price Index inflation could raise expectations for more hawkish Fed policy and drive bond yields up further. Prices rose 3.3% from a year ago last month from 3% in June, a separate Reuters poll predicted. Interest rate futures are now pricing the first Fed rate cut in May 2024 instead of March a few weeks back. The market is currently pricing 6 rate cuts next year. I don't see that because I don't think inflation will go back down to 2%. Preventing the Fed from cutting too aggressively, said Jiawei Ren, portfolio manager at Penn Mutual Asset Management. For inflation to go down from 8% to 3% was fairly easy, but going down to 2% will be very hard given the very strong labor market, he added. What do you think Raoul Pal meant when he said something will break? We would love to hear your contribution in the comment section below. Also, don't forget to like, subscribe, and turn on notifications. Thanks for watching.